Again, my name is Jason Dahl. I'm a certified financial planner and a partner at AFS Financial Group. And per usual, I am joined today with my colleague, Alp Adebeck. Alp is the founder and managing partner of AFS. And today we're going to dive into simplifying ESG investing. ESG investing has really ballooned, I'll say, in popularity over the last 10 plus years. And in today's session, we're going to cover a little history along with, I'll say, the primary characteristics of ESG criteria and evaluation methods, and explore how this investing focus may factor into your portfolio. We'll also review a few fund examples and look at how to assess a fund with an ESG lens. Speaking of, those of you who know me, I normally wear contacts, but today I figured I'd put on my ESG lenses. Again, before we get started, just a couple quick notes. We are recording today's presentation. So as a follow-up, we will send a brief email with a link to the recording, the slides, and so please feel free to share that when you get it. But we will provide the recording and the slides. And lastly, of course, please don't hesitate to ask questions at any point throughout the presentation. To do that, we ask that you please type them into the Q&A link or chat link on the control bar. Now we are going to kind of move at a brisk pace. We're really kind of taking a high level approach to ESG. There's obviously a lot more to it, and if anybody wants to talk more specifics as a follow-up about ESG investing, happy to do that, or really anything, please don't hesitate to reach out. I'm happy to schedule a time to connect on the phone, over Zoom, or in person. And as I always like to say, we really do love what we do. And the best part of what we do is connecting with folks like you to help you solve personal financial planning puzzles. So don't hesitate to ever reach out. So the obligatory disclaimer, this session is for educational purposes only. Any of the funds that we reference are exclusively used as examples. And of course, if you're listening to this as a recording, we're recording this as of March 30th, 2023. All right, so diving right in here, I'll say kind of really the main goal in our view for today's session is to provide some defining features to ESG investing, and hopefully have you walk away feeling like you know more about kind of what is and what isn't ESG, and kind of the why behind how ESG can be a useful investing lens in your investment process. It can be difficult to sort of define, and while the S and the G do stand for something, I'll also share that in just a minute. It can vary kind of across industries, and that's part of what we want to try to hopefully demystify or clarify a little bit today. And there's definitely been an evolution over the years, and so we're going to give a little bit of that history, that evolution,
and a revolution, I would say too.
I think that's a fair way to put it as well. We're not going to dwell on this, but like so many things today, unfortunately, I'll say ESG investments kind of have become politicized. And I'll just say personally, I kind of think some of that criticism or fear-based pushback, if you will, is a little bit misguided in some respects. I can understand if you want to take issue with maybe a private company's choice of what they do, like through their giving, right, or their foundation, or right, like that. That's to me, certainly fair game for criticism, but simply utilizing an ESG-based kind of investment factors kind of into the criteria, I don't think that really is the problem in my view. So that's just sort of my little 2 cents on that issue. But we're going to try to be a little much more fact-based kind of as we go through today's presentation. So we really are focusing on making sure like we understand how ESG factors into the investment analysis and decision-making process. So as promised, if you didn't already know, E, S, and G stands for environmental, social, and governance. And these three principles really comprise, I'll say, a set of standards that investors can leverage to evaluate investments, right? Like that to me just is kind of the simple definition of what ESG is and how we kind of apply it. So the ESG kind of evaluation, right? Kind of the process here. I'll say, in my view, kind of the core point is that it can enhance traditional financial analysis. I'll say. And so while social awareness is a forefront goal for some ESG investors, the main objective remains financial performance, right? Or the classic kind of risk-adjusted return potential, right? I mean, that's really what is underlying ESG. And we're going to just explain sort of how that can sometimes creep into the gray area of other sorts of criteria or lenses that people put in, but really want to emphasize kind of from our perspective that's at the core, right? There really are many investors who I'll say have little or no kind of personal or sort of value-based quote unquote incentive when incorporating an ESG lens in their investment process. And so for many, it is seen as just simply an enhancement or a deeper dive into the evaluation process.
So Jason, I know one thing that we get a lot of questions on is companies themselves. How do they look at this? So if I'm a major company, if I run a major company, what's happening in my boardroom right now when it comes to ESG?
Yeah, a great example, right? So that particular example kind of falls into the G, the governance piece of it. And it's sort of twofold, I think, Alp, is companies across all sectors, across all industries, sizes, you name it, have recognized, I'll say kind of on the one hand, the value of a diverse board, right? Particularly, we've seen a big push on more women in leadership roles and decision-making roles in boards, and companies have recognized, oh, that adds value to our company, right? And that's a driver, right? That's at the core of all for-profit entities, right? Is how do we become more profitable and potentially reduce our risks, right? And so by having a diverse board, companies have recognized that it can help them see potential risks better, but also just kind of that perception from the outside world, right? That's become more and more in today's kind of, I'll call it social media, instantaneous news cycle.
Instantaneous bad news cycle.
Bad news cycle, right?
They're trying to avoid that.
Absolutely, absolutely, yes. It's a great example, and one of the areas that we've seen a lot in that kind of evolution in this area. So speaking of kind of that evolution, just a kind of quick history, if you will. So we've seen ESG investing really kind of move out of kind of niche territory to becoming kind of a core criterion for many institutional and retail investors. So if we rewind back to kind of the 1920s, right, where this was really kind of driven from what was called an exclusionary kind of screening approach, often referred to as socially responsible investing. And this is where investors kind of followed the idea that by excluding certain companies or industries from their portfolio, they could avoid exposures to businesses that conflicted with their personal beliefs, right? While potentially enacting change, right? But primarily it was from an exclusionary perspective, right? And often it started kind of primarily from a faith-based approach. So it was often adopted by religious institutions, which would divest of certain companies or investments that conflicted with their beliefs. So here's where you can kind of think of that classic quote unquote sin stocks, right? So things like alcohol, tobacco, gambling, these were often excluded kind of based on religious beliefs, right? So that's a little bit of sort of the beginning days, sort of what has now evolved. I'm just going to sort of skip the middle there. You can read that and kind of jump to today, if you will, kind of the fast forwarding to the 2000s, where I'll say the ESG kind of space has kind of hit exit velocity with large pension plans, endowments, and I'll say most other institutional money managers now incorporating some degree of socially responsible investing into their investment policy statements. And I should clarify, because I do think there's an important distinction in today's world between socially responsible investing and ESG investing, and we're going to talk more about that. So today I think it's more an incorporating of ESG screening into that kind of from an institutional endowment pension plan perspective.
And I'll add, Jason, that for a little history, most people don't realize that Calvert Group, which is probably one of the early adapters of ESG and socially responsible investing, was originally a Bethesda-based company. So if you drove into the DC area, drove into Bethesda, on the skyline, you actually would see their name on top of one of the buildings in Bethesda.
Yeah. So definitely a great resource. It's a great company in this space. Been around a really long time. Does a lot of good research. They used to manage the DC 529 plan for many years. But so really right. So on the far right, when we're talking to the ESG investing, this is really where kind of the integration starts, right? For incorporating ESG factors into the investment decision-making process, alongside, I'll say, kind of the traditional fundamental research, right? To both assess material risks, right? Because that's at the core of any investment, analysis process, as well as seeking opportunities, right? Kind of where the future is going, or where maybe you could say the future already is.
And I would say like the greatest impact probably has been in the last 5, 6, 7 years on how it's affected the corporate boardroom, where I think you didn't hear too many questions about ESG on conference calls prior to 2015, 16, 17 timeframe, but today it has really picked up a lot of momentum.
Yeah. So kind of adding some further sort of clarity or distinction between some of the buzzwords, if you will, in this space. It's really kind of three investment styles have kind of led the way, right? We're going to focus on the ESG investing or ESG integration. Then you have socially responsible investing or thematic investing, and then impact investing. We're going to talk more about each of these, but these methods really have a few key differences that impact kind of how your portfolio may be structured, and which investments are most suitable for meeting your goals. All right. So SRI, or socially responsible investing, involves, I'll say, actively selecting or removing investments according to kind of your specific ethical guidelines, right? That's kind of the added layer to the process, right? That's kind of where SRI, socially responsible investing, sort of distinguishes itself. That the underlying motives of socially responsible investing really could be anything from religion, political beliefs, personal values, right? Sort of applying that to your investment process, and kind of the goal is to both generate positive returns, but without sacrificing one's kind of social conscience. Okay. SRI, I'll say, kind of takes ESG that step further, right, by adding that additional layer of investment screening that involves your personal beliefs and sentiments. Impact investing. So what is that? The impact investing has really gained in popularity in recent years. So with impact investing, investors are seeking companies or investment opportunities that intend to generate a positive and measurable social or environmental impact. Right. So think things like climate action, gender equality, affordable housing, or education. Right. These are just to name a few examples. Right. So these sort of look toward helping business investors who are looking to help businesses that have specific goals aimed to benefit, right, society or the environment. And I think it's important to recognize that this approach, may potentially involve additional risks as an investor, or potentially lower, expected returns compared to some of the other approaches, because it really is sort of first driven by wanting that impact from the social or environmental component to it. All right. So again, important to sort of distinguish each of these from one another.
And so, Jason, when it comes to our practice, what do you like? How would you characterize as what we're seeing from clients? Like, what's the main focus we're hearing from our day-to-day clients?
Yeah, no, I think it's a great question. First of all, I think a lot of clients, understandably so, kind of confuse or blur these different areas, right? And so we'll have a conversation a lot about, okay, a question of, hey, what are some investments that might be addressing things like climate change? That's probably the most common sort of area that we get that falls under ESG, is thinking about the environment and climate change. Not exclusively, but the most common. And then we have a conversation of sort of recognizing and distinguishing the sort of purely, hey, let's apply sort of a sort of a traditional research analysis with an ESG lens, right, to someone's portfolio, not at the risk of sort of giving up potential returns or taking on additional risk, because someone is saying, hey, I'm primarily driven by sort of my social or religious or values based. I think that's probably the conversation we always start with, is understanding the distinction, right? Is, okay, what's the motivation here? Are you going for that impact, right? Recognizing that there may be additional risks or potentially, lower returns versus just incorporating the ESG lens to the investment process. All right. I mean, I think that's where it really begins. And then we oftentimes will say, all right, great, that's helpful. And clients will say then, but I want to avoid certain companies for whatever reason, right? Like, and that's a common, conversation that we have. Think of it from, just someone's employer who might say, hey, because of their employment, they have to avoid certain companies and industries. It's kind of the same conversation, right? That folks say, oh, because of my employment, I have to avoid certain areas. But similarly, just because of my own personal beliefs or because I think that maybe is a dying industry and I think it's a bad investment, I want to avoid certain areas too, right? So that's sort of big picture. I think where the conversation sort of begins with clients. So here, I think is a great kind of summary, if you will, of the environmental, social, and governance components. Right. So the E factors related to the, I'll say, quality and functioning of the natural environment, right, and natural systems. So examples will include things like emissions, waste management, and access to clean water. Lay out a great example, right? I think BP's Deepwater Horizon oil spill is probably the highest profile ESG transgression, right, in recent history, and illustrates the impact that environmental mismanagement can have on company stock performance. Right. So I think it's a great example of sort of the value of the E lens, if you will, of trying to identify companies that maybe have risk exposure in that area. Social, the S, right? So factors related to think of the rights, well-being, and interests of people, right, and communities, right? So the employees, the communities in which the company operates or sells their goods or services. An area that sometimes is overlooked, think of a high-profile data privacy breach or a product recall due to safety failures, right? These can have significant long-term consequences for a company, right? Damaging their trust, customer trust, attracting regulatory scrutiny or even fines, right? And driving up costs. And then lastly, governance, and not leastly, but just in the order of the letters here, governance. So that these factors are related to the way companies are managed and overseen, right? So examples may include executive pay, board composition that like Al brought up earlier, and ownership structure. One example here can be executive pay, right? If the executive pay is primarily driven or incentivized by short-term achievements, companies can develop a culture of excessive risk-taking, right, that may damage long-term performance. And that has certainly been a discussion in the last couple of weeks when you think about some specific banks and the governance in that area.
I would also say on the governance part, it's probably one of the areas that I've been most disappointed on, where, I get your example on the not aligning executive pay to short-term performance, but overall executive pay, I think, is almost falling on deaf ears. I think it's still just extraordinary what the compensation is out of some of these big companies to their C-suite. It's just extraordinary income, and in my opinion, not warranted.
Yeah, yeah. No, I agree with that sentiment. I think that there's a lot of room for improvement in that regard, for sure.
That's one that's been the most disappointment, I think.
So I love this slide. I think it's a really great visual that does a nice job of kind of illustrating some of the, I'll call it, focus areas within each of the E, S, and G issues. Not going to read them out loud, and you can all see them. Like I said, I know some folks joined late. We will be sending this recording and the slides as a follow-up, so we'll get these to everyone who tuned in today. But I think this slide does a great job of providing a framework for many investors, kind of when thinking about the ESG factors. They're researching, right, to determine what companies may be better positioned to outperform, kind of going forward, right? I mean, I think again that's kind of our primary focus when thinking about utilizing ESG in an investment process. And so I'll also say that there are various research services, and this is an area that Calvert was very early in this space, but not alone, certainly, that have been trying to I'll say create or apply kind of a scientific measurable approach, right? Think of like a scoring system to each of these areas. Right. And so we're going to sort of show a slide later that is one example of this, so that all of us as investors can try to compare apples to apples across industries and companies. And that is one of the still, I'll say, evolving areas of kind of the ESG process. There's still not a perfectly sort of agreed upon standard set of criteria. There's some that are rising up, and there's definitely a lot of commonality, but that is continuing to grow and evolve. If you think about it, how difficult it can be to sort of measure the some of these, right? Even just going back to our earlier example of board diversity. How do you measure the value of board diversity, right? Like how do you measure something like avoiding a risk, right? All companies do risk management, risk assessments in different ways, but some of it can be hard to sort of measure and give a score to or dollar value to. And sometimes there's just sort of you just know it when you see it, right? Hey, we're a better run company because of our board diversity, right? So that's where sometimes it can be difficult to sort of measure the impact.
And so I'd say today there's also been a lot of emphasis on the social part of it. If you look at the bottom three, workers' rights, local community impact, and human rights, I think you're seeing a lot of new developments in that area with some companies that are forming unions, which and some of the newer, I'll say, faster growing companies, that Amazon, et cetera, Starbucks, and they've been hit with some unionization efforts. And it's been interesting watching that development. And also one thing that I think has really been fascinating, if you're looking at some advertising for big companies, you can see that it's actually focused on your local region, where you'll see companies that will talk about the donations they've made to support the local communities. Will they share their profits with the communities? I think that's really been a big effort by companies.
We'll talk a little bit about how that can sometimes blur the sort of the greenwashing effect. But that also one of those sort of areas to consider in ESG. But we'll come to that in a few minutes. So why ESG, right? So just a high level list of some of the reasons that investors incorporate ESG criteria into their analysis. And I don't need to read it, but I'll just start right there at the top. Again, I know I've said this multiple times, but any investor, not any, most investors, right, sort of their traditional approach, they're just saying, hey, by incorporating an ESG lens, if this can potentially improve my financial performance, my risk-adjusted return, I'm all for it, right? Same in a boardroom, right? Hey, if incorporating this relatively new sort of way of thinking, if you will, or some of these criteria is going to improve our performance as a company, they're going to do it. All right. And that to me is just sort of the at the most simple level, sort of the why ESG. Just a simple chart just showing sort of the rapid rise in popularity and the projected increase of sort of ESG interested investors, right? Not only just interested, but real dollars moving into investments that apply an ESG lens. Just a couple quick stats. Thanks to Morgan Stanley, among institutional asset owners, right? 95% are integrating or considering integrating sustainable investing in all or part of their portfolios, and 57% envision a time when they will only allocate to fund managers with a formal ESG approach, right? And so I think, again, that's sort of the trend. It's just incorporating an ESG approach into the sort of core, traditional, fundamental investment approach. So who are some of the kind of key players here, right, or key stakeholders? Perhaps obvious, right? But you've got investors, right? You've got advisors like us working with and helping investors. You have the companies themselves that we've been talking about, and of course, policymakers. Policymakers always play a hand in either potentially kind of hindering or slowing down in certain areas, right? Or enabling, right? So think of, just the simple examples of like tax credits for certain areas, or carbon taxes, carbon offsets. That's probably one of the biggest areas that we're seeing where policymakers are impacting the E component around the world. We'll talk a little bit more about that as well. So I believe, again, one of the goals of applying an ESG lens to the investment research process really is to measure and manage a greater number of potential risks, right? I do think that there's almost like an equal weighting of, hey, where are the opportunities, right? And thinking about environmental, social, and governance, that sort of where the world and companies and businesses moving to. But then there's also just the realities of, oh, what are some of the risks that maybe we've not been aware of or been attuned to as a company or as investors in the past? And I think ESG applies some value definitely in that area, and this slide just sort of shares some of those examples. So why does it matter to companies? Again, I already stated this, right? To improve long-term financial performance, right? So if incorporating ESG leads to better performance, they're going to do it, right? Higher profitability, lower company-specific risks, lower exposure to systematic risk factors, all of those things are going to be included in there. And then just sort of the reputation risk. I know, we've talked a lot about that, right? Just that how quickly some company or, a leader in a company's name can get out there in the news and how that reputational risk can spread.
I think we saw a great example of the speed of social media in the collapse of Silicon Valley Bank. Most people don't know what happened behind the scenes unless they actually read some of the articles. But Peter Thiel, a famed venture capitalist, advised his portfolio companies to remove their deposits from Silicon Valley Bank. And basically, in 24 hours of him making that statement, $42 billion were wired out of the bank. And so it just shows you what can happen today with the speed of social media. I mean, that message got around incredibly fast. And I think companies are trying to avoid that affecting them.
All right. And while that specific example may not necessarily fit into this ESG, right, but it's a great example of how fast things can happen.
How quick a reputation can be tarnished.
Right. And so how important it is to stay abreast, stay attuned to those kinds of risks.
And stay ahead of the issues.
Yep. So why does it matter to investors, right? So for me, again, what distinguishes, going back to earlier conversation, it distinguishes ESG from SRI, right, or socially responsible investing, or values-based investing, or impact investing, is that ESG investors are still primarily driven to seek a better return for a given level of risk, right, within their portfolio. As we've sort of touched on a little bit in recent years, we've definitely helped clients incorporate ESG areas into their portfolios that they genuinely care about, right? Then that might include energy efficiency, climate impact, corporate board diversity, female leadership, just to name a few. We've also helped clients who've expressed a kind of a negative screening, right? And so involving excluding potentially unsustainable companies or sectors from their portfolios that they want to make sure that their money is not going towards. And again, as we mentioned before, probably sort of the fossil fuel kind of big oil traditional energy companies being probably the most common example that we get in that space. All right, so a little bit commentary on sort of the role of policymakers. I don't think we want to get into a discussion today of kind of the current state of policy, but what we do want to highlight is the importance of considering regulatory or policy risks really to any investment, right? Because that is an underlying component for sure, but especially how that can present unique risks that ESG investors really seek to mitigate. Again, I'll say kind of the biggest headline area here is related to climate change and carbon regulations. I'll say, pretty much all companies across all industries, all sectors are starting to factor in or project the additional cost of carbon offsets, I'll say, into their financial analysis. We're just hearing that more and more. Certainly, I'll say kind of Europe has been the leader in that space, but it's, the state of California has a big market. In New England, there's a multi-state kind of carbon offset market. And a lot of folks believe that it's inevitable that it's just going to continue to grow. And as an investor thinking about companies, okay, are they prepared for that additional cost? Right? It's think of it like a tax to companies to offset their carbon emissions. All right, so now let's kind of narrow in a little bit, sort of think about how to integrate sort of ESG into the investment process, right? Sort of from our perspective and from individual investors. So we've got a couple slides here that I think kind of the recurring theme here, I'm not going to read each of these, but is just kind of a very high level kind of review, if you will, of sort of the traditional process, right, of thinking about investing, sort of narrowing down the investment universe, screening the companies, doing fundamental analysis, right? But in each of these examples, it's really just that plus sign, right? It's just an additional integration of ESG considerations, right, to help narrow down the huge world of investment options out there. And you come right, the multi-step process here, and it's not only just making the decision, right, optimizing the decision, but then ongoing monitoring, right? And then on that the last point here, we'll see different investors may take a more active role in play, shops like Calvert, they talk a lot about this, how they, in certain funds, they may say, hey, in one of their approaches, maybe, sort of that being an activist investment, right? So trying to gather votes and speak up to the board of companies to try to, sort of push in certain directions.
Now, most of that seems like it's more profit driven today instead of environmental driven, even though I think on the Exxon example, I'll defer on that one. But overall, I think when you see the activist investing, it really is, it seems like, unfortunately, more profit driven as opposed to environmental concerns.
Yeah, you definitely hear more about that. For sure. Again, I like this slide a lot, and maybe it's just because I like bright colors, but I think it does a really nice job with each of these sort of 4 quotes of kind of encapsulating sort of the differences, right? Kind of the values versus true ESG evaluation, right? So starting in the lower left-hand side, right? ESG integration, think of it as I want to integrate ESG factors and traditional factors to assess the risk reward profile of my investments, right? That's what we've kind of been focusing on in today's conversation. But then where the lines kind of sometimes get blurry, but I think this quote does a nice job of sort of clarifying, is exclusionary investing. I want to screen out controversial companies or sectors that do not meet my sustainability criteria, right? So you as an individual investor. Inclusionary investing. I want to seek out companies that are ranked highly in their sector based on sustainability criteria. And then on the far right, we talked a little bit about impact investing. So as an impact investor, I want to invest in companies that attempt to deliver or a measurable social or environmental impact alongside financial returns. So oftentimes kind of the financial returns piece is alongside or sometimes even secondary in importance.
So Jason, when it comes to impact investing, I think a little bit of a slant on that is when people have invested in their own homes, solar, or invested in a new car and have gone EV. So I think we see a lot of questions related to that. On the subject of exclusionary investing, how would you characterize 2022? Because I think we had a number of people, I'll say after 2020, 2021, that people were getting fed up with big oil. And
yeah, it's a great stark example. So for any investor, and we worked with several, right, who prior to 2022, for various reasons, right, might have been sort of personal values-based driven, or just kind of a recognition of, hey, you know what, I think this is a dying industry. I want to move out of sort of traditional fossil fuel investments. And so they sort of have taken an exclusionary approach, said, all right, I want to divest of direct exposure to the oil industry, right?
And that could have been individual stocks they held,
or
like
inside
Exxon,
of or inside a mutual fund, right? Because there are funds that's part of their criteria, is to exclude those kinds of companies inside a diversified fund. And if you did that leading into 2022, if quick recap here of 2022 in the equity markets, really the only positive investment sector was energy, traditional energy in 2022. So for folks that had that applied that exclusion in 2022, they underperformed relative to an investor who maintained that traditional energy exposure. Now,
and
granted,
can you define underperformed?
Yeah, I mean, I think we compared two funds that had almost identical underlying holdings with just those one exceptions, right? That they didn't have Exxon, they didn't have Chevron, and so forth. And in 2022, they underperformed 8-9%, somewhere in that range.
The whole
For the whole
fund.
fund, yeah.
So if somebody had, I'll just throw out a number, if they had $100,000 in a large cap value fund that excluded energy, that probably lost about 10% in 2022, while the ones that included energy in 2022, the Chevrons, the Exxons, because they were by far, not just the ones that made money, but by far the star of the show in 2022, those funds actually broke even compared to the overall market being down about 18% or so. So it's really fascinating that I think we had a number of people that were fed up with big energy in 2021 that started excluding it from their portfolios, again, either selling out of specific companies or finding funds that basically did not include them in their portfolio. So it was really interesting when we were doing the review of it in the middle of the year and also at the end of the year. Just
And an important reminder, right? That 1 year is
yes,
it's just that.
absolutely.
It's just 1 year, right? Because to be fair, right, if you looked at the prior 10 years, the reverse was true. If you'd excluded energy, you would have outperformed, right?
Without a doubt.
But it's just one of those a great kind of stark, recent.
Yeah, in a bad market, right? It just kind of magnified. It was like, oh, that's interesting. Had we held on to it.
Yep. So Al, but so we talked a little bit about some of the, sort of how this big picture stuff we've been talking about sort of flows into some real world investment examples.
Yeah. So probably one of the easiest things you can do is you can Google ESG focused companies, and if you want to buy individual securities, you can find list of companies that score well, and you could actually invest in companies that you like, they fit what you need in your portfolio. But a simpler way is actually just picking up exchange traded funds. There's open-end mutual funds and exchange traded funds. Exchange traded funds basically have gained in popularity over the last 5 to 10 years. And so whenever there's like a new theme, and if we throw this in as a theme, ESG has gained a lot of popularity in exchange traded funds. So it's basically a really simple way to pick up a basket of stocks that adhere to your ESG focus. Very simply, just one quick trade. An exchange traded fund is different than an open-end mutual fund. It actually trades on the exchange, and it trades throughout the day as compared to mutual funds that actually only trade at 4 p.m.
Settle at the end of the day. Yeah.
But so there's a lot of choices on the ESG side, and you can also pick up fixed income. So if you think about most people focus strictly on the companies, but they're forgetting a lot of companies raise debt. And so you're now seeing bond funds, bond exchange traded funds that you can actually get that have an overlay of ESG to it. So very simple, very straightforward, same benefits, complete diversification. You could buy individual bonds of these specific companies that you want to have, or you can pick it up in a fund. So very straightforward there. And we have a few examples, and they're really in no particular order. So we have iShares Global Energy, and we'll go over all 4 of these on the next 4 slides. And basically, you see Calvert International Responsible, Inspire 100, and then Calvert Ultra Short Investment Grade. So the first one, the iShares Global Clean Energy. One thing we always recommend for people when you're thinking of a new investment, if you're doing the screening yourself, we suggest you review the fact sheets. And so they're out there for regular funds, and they're out there for ESG related funds. And things we look at is trying to understand the investment objective of the fund. So this says the iShares Global Clean Energy ETF seeks to track the investment results of an index composed of global equities in the clean energy sector. And so if you look at the top holdings right there, one of the things you'll notice, no big energy. And other things we also look at is the concentration of it. So this particular fund, which is a popular fund, you'll notice that the top holdings because some of them have performed very well over the last few years. They make up a fairly large composition of the fund. So First Solar is 8.2% of the portfolio, Enphase Energy almost 8%. And so when you're looking at some of these, you might see them a little bit more concentrated because they tend to hold on to the positions that have done really well. But this is a great example of a fund if you're looking for just clean energy as a substitute for, I'll call it, classic energy in your portfolio.
I'll just add, this is, I think, a great example of some investors may be motivated twofold by, hey, I think this is the future. I think this is a great investment opportunity. There's great growth opportunities here. You might also say, and I, by the way, I want to get out of traditional energy because I either, maybe ethically am opposed to it, or just think that, hey, you know what, that they've sort of run their course and they no longer are the future.
So this is by the Calvert Company that, as we said, was originally based in Bethesda, Maryland. So this is their international responsible ETF, and it's basically to gain diversified exposure to international companies that Calvert believes are demonstrating effective management of key environmental, social, and governance risk and opportunities. And if you take a look at the holdings here, so this is basically a foreign large blend fund, so larger companies. And you'll notice there's a lot of common names that you're familiar with every day: Taiwan Semiconductor, Nestle, Samsung, Roche Holdings, Toyota. So these are companies that you're thinking of a traditional car company. Toyota doesn't really have that much of an EV presence, but they're basically adhering to other standards that Calvert believes allows them to be included in this particular fund. So take a look at the holdings. And if you like what you see, it's a great way to integrate international exposure to your portfolio through an ESG lens. Next one is a great example of a faith-based fund. And so in all my years of doing tax work back in the 80s and 90s, this is actually something that I never really focused on, but I would always get 1099s from faith-based funds. So people would come in when we're doing their taxes, and they would hand me the 1099 for usually various religions that just focused hard on, they only wanted to invest in certain industries. And if you were a member of that religious organization, they generally encouraged you to invest in these type of funds. And so we'd see a lot of people that had those, and again, wide variety of religions. And so you can just see the top holdings here. So this one basically is a morally responsible, biblically responsible fund. And we have one of our 401k clients is a religious organization, and basically they have these type of funds in their portfolio. It's very important to them. It has to align to their basic visions.
Yeah,
Last one.
And the full fact sheets for any of these, right, will really kind of give you more definition, sort of what do they mean by their criteria and screening.
I would also say that you can actually Google faith-based investing, and you'll come up with through, I think it's Investopedia, there's just a great explanation of it, great summary of it. So I found it very helpful. I think when we were preparing for this, it really, just gave you a lot of insight into it. So this is just a bond example. This is Calvert again. It's their ultra short investment grade. And so this is basically buying bonds within this exchange traded fund through companies that meet their criteria. And so you're actually going to recognize a lot of the names. You'll see United, Verizon, Bank of America, Citigroup, Nationwide, NextEra Energy, which is a Florida company. So really good example of just picking up a fund that is fixed income related, and it allows you to fill the fixed income slot in your portfolio with an ESG fund. And this next slide is probably something that was great timing. So I think we were putting together this presentation for DC Bar probably about a month ago. And I think a couple days before the presentation came out, Barron's on their weekend edition had their 100 most sustainable US companies. And interestingly enough, put together with the assistance of Calvert Research and Management, but they scored the 1,000 largest publicly traded companies across 230 environmental, social, and governance issues, and basically came up with the leaders. And so they scored, once again, 1,000 companies. You'll see the top 10 here, and it's kind of interesting that Clorox is on the top, right? But shows you what the returns are, market value of the companies. From the article, one thing that I thought was really interesting, Chris Madden, this is a quote, a portfolio manager at Calvert, says scores are becoming tighter as more companies take sustainability seriously. So they're basically telling us that you're seeing more and more companies, Jason has mentioned this throughout the presentation, that are really focused on these issues, and they're trying to avoid negative press. They're trying to do the right thing, and they're basically finding it more difficult to screen out the companies because almost everybody is adhering to these standards now. And if they're not there now, they will be there over the next couple of years.
Yeah, thanks, Alp. And we kind of hinted at a few of these items, but I think it's important to sort of note, some of the potential drawbacks to any kind of ESG lens or approach, and think of I talked about this before, kind of a lack of industry standards, right? So there's still kind of limited ESG disclosures and reporting requirements. Think of that from the individual companies, right? So so on those different scoring systems, if you dig into them, you'll see that some companies just didn't report, right? Or there's no publicly available information for some of the criteria, right? So that can be an issue, right? If you're only getting information, an inconsistent set of data across different companies, that is still an area to overcome. And then just different rating systems, right? So even though Calvert may take a different approach from many of the other different kind of scoring and rating agencies. And then lastly, we touched on this a little bit, sort of the greenwashing, right? So essentially sort of a company kind of falsely claiming or sort of faking their way into convincing the public or investors that they're doing better than they really are doing, right? In any number of these, E, S, or G criteria. And some companies might say, what, hey, it's worth it for us to just spend more on the PR piece of it right now than the actual sort of criteria.
Or they'll announce a large investment, but it might take 10 years to deploy it. But again, it's moving in the right direction, but no question there's a lot of greenwashing out there right now.
So one of the areas that's been in the press a lot lately and in the last few years is ESG criteria and investments within company or employer sponsored retirement plans, right? So think 401ks and 403bs and so forth. So just to kind of wanted to share sort of a quick recap, sort of where we stand today. So in late 2021, the Department of Labor under the Trump administration released guidance on the usage of ESG investing in retirement plans, which created really, I'll say, stringent criteria and therefore risk for the committee members on these retirement plans at the companies to even select any ESG related fund to be added to the plan's investment menu. Now, fast forward early into the Biden presidency, the Department of Labor, quote unquote, paused the prior guidance and opened a comment period for ESG investing in retirement plans. From there, the Biden Department of Labor released proposed guidance that really sort of swung it the other way, in the other direction from the prior guidance under the prior administration, seemingly indicating that ESG metrics, specifically climate, should be a component to all investment due diligence. So this received a significant outpouring of commentary from the industry and among others. So really sort of where we are today is as of in November of 2022, the Department of Labor announced a final ruling, which in our view struck a careful balance, right? We're basically saying that 403B and 401k plan sponsors, so the companies, right, that sponsor the retirement plans, could consider and select investments that followed ESG or other specific metrics, as long as they follow a consistent and objective process under ERISA, which is the law governing retirement plans, for the selection and monitoring of investments. So So in the meantime, of course, this is working its way through the courts, where there are multiple lawsuits in an effort to block this DOL rule. The House and Senate recently passed measures to remove this ruling, which is expected to in turn be vetoed. So in the end, the rule poses currently no requirements on an organization or their retirement plan committee to use ESG-centric investments. It just provides the option and a framework for fiduciary governance to do so, which, in my humble opinion, is kind of where it should land, right? Sort of, if you're on a plan retirement committee, you shouldn't be at risk if your company wants to offer, a fund that you've done your due diligence on, right? That meets both sort of risk and performance expectations, but also applies an ESG lens. But I don't think a company should be banned from doing that either. But there will be, I'm sure, more news coming out on that front in the coming weeks. So if you're interested, want to get started sort of thinking about effectively integrating ESG strategies into your portfolio, I'll say, right, like anything, it depends kind of on your individual investment and personal goals, your risk tolerance, your time horizon. So while ESG investing may not be right for everyone, if you do determine that adopting an ESG investing approach is right for you, we recommend adhering kind of to start with from a simple sort of 3-step framework when getting started, right? So define your sustainable investing goals, right? Is it primarily driven from investment returns, and you just want to include this additional sort of criteria, or are you saying I want to exclude or include or seek impact, right? And then from that process for narrowing your investment focus, and then to our earlier example, always better to take a long-term approach, right? A single quarter, a single year is usually not a good enough, long enough period to sort of judge an investment. Now, of course, at the core of any investment process, right, always think about your risk profile, right? What's your comfort level or tolerance for risk? How much risk do you need to take in your portfolio, right? What's your capacity for risk, right? Given your overall financial plan and net worth and so forth. Right, so it's always important to not lose sight of that sort of these core components, and sort of at AFS we kind of view the integration of ESG, right, and kind of how you can take action is sort of incremental, right? So sort of phasing it into a portfolio. It's not common that someone, or that it's really appropriate for someone to just say, you know what, I want to sell everything and just buy all new investments that are either exclusionary or inclusionary or have impact, right? It's using, okay, I want to start incrementally incorporating ESG criteria on my investments, and that might be an approach of including some exclusionary criteria or inclusionary criteria. It might mean sort of a least bad actor approach, saying right, like if somebody says, hey, I want to keep exposure to the energy sector, but among the energy sector, who's the best, right? who truly is investing in cleaner energy sources?
Best or least bad is what are you going to say?
The least bad, yeah, right. Depending on your view, right? So
Jason, a quick question for you that I didn't see. I don't know when it came in, but what are examples of supply chain standards in ESG?
Examples of
So I would think a little bit more along the lines of maybe companies that have had trouble with where they were manufacturing. They had employees that were below certain ages, right? So I think you're seeing that. I think it's a little bit more on a combination of like social and governance in those examples.
Yep. We've definitely seen an ESG lens that applies to worker conditions globally in the world, right? Human rights, right? You sort of saw that, their impact to the community in which they work, and you can see how some of those risks that a company, right, whether they're producing it themselves or they're subcontractors, right, who are producing that, if their workers strike, right, because of poor working conditions or poor environmental conditions, or the community in which they operate, quote unquote rises up, if you will, in some
Sure.
fashion, right, to disrupt supply chains, right. These are all the kinds of things that the companies are thinking
Yeah,
about.
and I think that particular example is probably one of the earlier issues that came up, and for the most part, I think the big companies, maybe 3 or 4 years ago, because I think Apple had some issues at one point, Nike had some issues. I think they've all focused on that
Yep.
and have cleaned up their supply chains. Um, I will say on the whole issue of supply chain right now, there is a lot of focus on diversifying it. So maybe we'll end up having some issues come up in the future because you're seeing people move away from supply chains that have been primarily focused in China, where they've had a big disruption that was COVID related. So if they move to new areas, hopefully they do the proper screening to
Mhm.
make sure they don't run into some of the old issues that they've already dealt with in the past.
Yep,
That's a good
absolutely.
question.
Yeah, it's a great question, and it's a great example of sort of the bleeding or blending together of sort of ESG criteria with just traditional risk management from a company, right? To say, oh, maybe we should diversify and onshore more of our
That too,
production or
obviously.
manufacturing. Yep. Yep. Or energy independence, right? Like there's a lot of criteria, whether that be from an ESG focus or a national defense, national security kind of focus. You can see how all these start to combine. Classic quote here from the famous NHL player Wayne Gretzky: "Yeah, skate to where the puck is going to be, not where it has been." Right. That's often sort of uh, um, um, often a sentiment expressed sort of in the ESG world of saying, "Hey, we're already here. This is where the future is incorporating ESG criteria." So we're coming up on the hour. Appreciate everybody joining us today. As I said, we will send out the recording and the slide. We do post all of our recordings and materials to our website, so please feel free to check it out. We've got a lot of recordings on a lot of different subjects, some one-pagers, infographics, and a lot of different subjects. So please check that out at afsfinancialgroup.com. And here's our great looking team. Please don't hesitate to reach out if you have additional questions or comments. We love hearing from you. Any other final words of wisdom out?
I think that's it. I think that the positive is ESG has made some big strides, and I know there's some people that are not as interested in it. I think indirectly it's going to happen, right? I mean, you're seeing a lot
Yep.
of emphasis on. I'll just kind of summarize it as doing the right thing by companies.
Yep, I agree. Well, thanks everybody. Have a great rest of the day, and hopefully you can get out and see some cherry blossoms. All
Take
right.
care.
Take care.